Robert Sockin of Citi Research on his outlook on global growth with the emphasis on what's happening in US and Europe and his view on what India GDP is looking like. Listen into this conversation.
Going into this year, we were expecting a pretty substantial slowdown in the global economy. The reasons for that are interest rates still remain high, and we see a lot of lagged effects of that in the system. Fiscal policy is likely to be less supportive than last year. The momentum within services sectors that we saw power growth last year, we think is fading, and the manufacturing sector was likely to remain soft. But now that being said, what we found is that even though we're still holding on to that view that growth is likely to slow, we've been marking up our global forecast over the last few months. The US has been holding up better than expected, as you noted. We marked up the euro area over the last 2 months, still looking for soft growth there, but better than we had expected a few months ago. And then if you look at the range of emerging markets, there's a lot of positive news there as well. We just marked up our growth forecast for China from 4.6% to 5%. Korea, a lot of other East Asian economies are showing strong momentum as well. And India closed last year very strongly, and we're looking for a solid year of growth in India for 2024. So even though all those reasons lead us to believe that growth is likely to slow, I have to admit that over the last few months, we've been surprised to the upside as Q1 data have generally come in better than we've expected.
Would this therefore lead to a slightly higher inflation expectation than otherwise believed? And could therefore the global asset uptake party be disrupted by slower and lower or both action from the Fed or the other global central banks on interest rates?
Absolutely. And this is the key question because, as you said, growth has been surprising to the upside. That might also mean that inflation surprises to the upside. And we've seen a fairly mixed inflation picture at the beginning of the year. Now, there's a lot of seasonal volatility issues to deal with in the data, but in general, you're still seeing fairly high services inflation in most major economies around the world. And that's really the key, is can you get services inflation to come down without a bigger slowdown in growth? If you can't, and the history would say it'd be very difficult, then, as you said, this resilience in growth may mean resilience in labor markets and services inflation. And that in turn would probably mean a slower pace of easing from major central banks. Now, that doesn't mean that you can't, this time couldn't be different, and you could get inflation coming down with growth being resilient. We're seeing a lot of improvement on the supply side of the economy as supply chain pressures have unwound, labor markets are healing. So you still may be able to get that services inflation down without a big cost of growth. But I think that's the big question mark for markets and central banks. And if you're in that world where growth is resilient, but inflation is also coming down slower, that means you're going to get less cuts out of the Fed this year, and that means you're going to get less cuts out of other central banks as well.
So what does that mean, Robert? I'm very inclined to understand from you. What does all of this mean for flows? Hitherto, I've been given a barrage of opinion that unless China growth picks up, flows into EMs will not pick up as well. Now, contrast that with the fact that China growth is picking up, but if the world growth is picking up and if inflation is higher and rates cuts are slower, that may have an impact on flows as well into emerging markets. So how do these two juxtapose in terms of what happens to asset classes by virtue of flows as well as natural valuations because of growth?
Yeah, it's a great question. And I would say, to your second point about natural valuations, this would be a broadly positive story in general if the global economy was able to weather the amount of shocks that it's seen and continue to perform at a strong pace. So I think, that's first and foremost would be good for asset classes more broadly, and risk as the global economy can continue to perform at the solid pace we saw last year. Now, to your point about EM versus DM flows, I think it raises a really critical issue, which is, you've seen emerging markets in this cycle. They hiked a lot earlier, their central banks, and they started to cut earlier as well in some of them, and we expect more to follow. But now you're getting to a point in those easing cycles where it really depends on what the Federal Reserve and other major DM central banks are doing in terms of the amount of easing and the speed of easing that those central banks are able to do. So, if we're in a world that we think where growth slows and the Fed starts cutting around June and continues to cut from that pace, I think that emerging markets can continue to ease policy, and you could still see a fair amount of flows into emerging markets. But it's this nexus of when do DM central banks move, and what does that mean for EM that comes down to the extent of these flows and how fast those EM central banks are able to move. So I think it really comes back to, as you were saying, what happens with the inflation picture and how fast are central banks able to ease.
My final question is on India. I heard you say that India, on the base of a very strong growth done last year, you're still penciling in strong growth. How resilient to your mind is the EM and the India economy looking? Because Korea has tailwinds because of the whole semiconductor manufacturing and otherwise.
Yes.
China, I've just heard you up this. India is not coming off a low base. So what's your sense about growth in India, and whether it can, earlier it was the beacon in a world which was not growing strongly, can it still lead the growth where growth worldwide is coming back?
Yeah, I think with India, we're looking for growth for this calendar year somewhere in the mid 6% range, around 6.5%. Very solid performance. A little bit of a slowdown from last year, but still very strong. And I think, as you said, what is the tailwind for that economy? As you mentioned, Korea has a rebound in semiconductor demand, but more broadly, I think something India is benefiting from, and you're seeing this in other East Asian and Latin American economies as well, is you are seeing a shift in global production away from China at the margin and to other economies in the world. I think India is a big beneficiary of that and will be going forward. I think other countries in East Asia and Latin America are as well. So I think that's something that's helping now and is going to be a powerful tailwind for India going forward. Then more broadly, there are other factors that we could point to that maybe argue there's some upside for India growth. Right now, as I said, we think the global manufacturing cycle is likely to stay soft for at least a while longer. But there have been some good green shoots where you've seen the manufacturing PMIs moving up around the world. So maybe if the global economy recovers more strongly, that would have a lot of export benefit to India. So I think there are a lot of benefits to India this year and next year, and some potential upside even if the global economy recovers more strongly.